Welcome back again to my YouTube channel, Study with Clef. My name remains Caleb, and today we'll be looking at another important standard, which is IAS 2, inventory. We have a list of items of what we'll be looking at today, starting from the definition, the methods of recording inventory, the stock taking, the measurements, the inventory valuating techniques, the disclosure requirements, and an illustration from the ICAN professional level corporate reporting May 2017 question 4. So starting with the definition. Inventory, as we already know, so starting from the definition, inventory are regarded as assets held for sale in the ordinary course of the business. I think we've mentioned something like this before in the first class. So inventories are hard assets held for sale in the ordinary course of the business. So, but it means several things. It means different things to different sets of business now. For example, if we have a retail company, let's say a retailer, inventory defined to a retailer are inventories are items in store or items stored for resale. So this is the definition of inventory to a retailer. So just like we said that generally inventories are assets held for sale in the ordinary course of the business. To a retailer now, inventories are those items in the store presently at a particular time or those items stocked for resale, meaning that a retailer will have to purchase something to sell. So he will have to purchase, so those items purchased stored in a warehouse for resale are regarded as inventory. Where right, also we have inventory as defined to a manufacturer. So to a manufacturer, inventories are the manufacturers will need several things to manufacture a product. We have the raw materials, the work in progress, and the finished goods. So to a manufacturer, inventories are those raw materials used to produce an item. Inventories are those process, that's conversion process from the material stage to the finished good stage. So that's conversion process. So that's work in progress. And then the finished good itself, after all conversion has been taken place. So after we've converted these raw materials to something that we can actually sell, that is finished goods. So to a manufacturer, inventory contains these three elements, which is the raw material, the work in progress, and the finished goods. So to a retailer, they are just items purchased for resale. So they are regarded as items in store or items stored for resale. Then to a manufacturer, inventories are raw materials, work in progress, and finished goods. So that's for the definition. So we have methods of recording inventory. So we have two methods of recording inventories. The first one is the periodic method. And secondly, we have the perpetual method. So for the periodic method, inventories are recorded only at the end of an accounting period. Entities are allowed to record their inventories using these two methods. So they can either record inventories using the periodic method or using the perpetual method. So if, for example, an entity decides to use periodic method for recording inventories, inventories are recorded at the end of each accounting period. That's for a periodic method. So for periodic method, inventories, they are recorded at the end of the accounting period. So we'll show an illustration, or we'll take an example, just a brief example to illustrate this so that we can understand better. And on the other hand, for perpetual method, inventories are recognized at every point in time, meaning that it is a constant updating of items. As we are purchasing them or as we are producing more, we recognize inventory. While periodic method recognize or records inventory only at the end of an accounting period. So perpetual method records inventory with constant updating. That's constant. So meaning that inventories are recorded at every point in time, every single moment that we have, just like we've defined inventory. So every time we have an item that belongs or to be categorized as an inventory, we record it as an inventory under the perpetual method. For the periodic method, it is only recognized at the end of the accounting period. So an example is if we purchase, let's say 10,000 goods on 1st September 2019. So from 1st September, say we purchased, I'm using a retailer for example now, we purchased 10,000 goods on 1st September 2019. If you purchase 10,000 goods on 1st September 2019, and then at the accounting year end, it will be from 1st September 2019 till 30th August. So period to 30th August 2020, we only sold 7,300. So at the beginning of the accounting year, we purchased 10,000 goods. Then from that beginning of the accounting year till the end of the accounting year, we sold a total of 7,300 worth of goods from these 10,000 goods. So we said we purchased 10,000 worth of goods on 1st September 2019. And then from that period till the end of the year, that's till August 30th, 2020, we only sold 7,300 worth of goods. Automatically, we will have inventory of 700. That's the remaining in store. So under the periodic method, it will recognize like this. So at the initial stage, when 10,000 worth of goods was purchased, we'll recognize purchases. Purchases is an expenses, so it should be debited. So we'll debit purchases, 10,000, and then we'll credit cash if we paid in cash or if we purchased on credit or payables, which is 10,000. That's at the initial period. At every time we purchase goods, we will debit purchases and credit either cash or payables. Cash is if we actually paid for that goods as at that time, or if we purchase them on credit, it will be using payables. So that's for that. So at the end of the period, remember we said this is periodic. We only recognize inventory at the end of the accounting period. So this is as at 1st September 2019. Now at the end of the period, we'll recognize inventory now. Inventory, which is inventory is an asset, don't forget. It's a current asset. Have 2,700. So recognize inventory of 2,700. We also debit cost of sales, which is the one that we sold, 7,300, making a total of 10,000. We purchased 10,000 worth of goods. We sold 7,300 worth of goods. Remember that this is not the amount we sold it for, but this is the worth of the goods that was sold. I'll take another one to show if we have the amount we sold them for, so that we can differentiate between both of them. So the cost of sale is 7,300, while the inventory, which is the amount or the goods left in store. Inventory is just those one held for sale, just like we said. Inventories are assets held for sale. So we still have them yet to be sold. That's inventory. So we have 2,700 worth of goods left in our store to be sold. So cost of sale, which we have sold, is the 7,300. So the addition of the two gives us a total of that 10,000 which was purchased. Then we'll credit purchases now to the recognized purchases. Purchases 10,000. So as at the year end, which is 30th August 2020, that is when we'll recognize inventory. This is using the periodic method. Using the periodic method. So that's an illustration now. If we are using the perpetual method, we said perpetual method recognizes inventory or records inventory with constant updating. So as at every time we purchase goods for sale, we will always record inventory as at every time. So automatically at the date of purchase, when we purchase this 10,000, we will recognize inventory. So we'll debit inventory 10,000. Remember, if we pay in cash, we'll credit cash. Crediting cash means that we are deducting from cash. Cash is a current asset. We've done something like this before. So cash is a current asset. If we credit cash, it means we are deducting from cash. So it's either we credit cash, and if we actually purchase these goods on credit, we'll credit payables. 10,000. So that's at the initial stage. So as at the year end now, this is as at 1st of September 2019. So as at the year end, we debit cost of sale, the amount that was sold was 7,300. 7,300. Then we'll credit inventory with 7,300. So we have initially debited inventory with 10,000. Now we're crediting inventory with 7,300. It means that what will be left in inventory will be 2,700, which is still the same thing with this. So it means that initially we have recognized inventory as at every time we purchase an item to be sold. So inventory was purchased on 1st September 2019. We recognize inventory of 10,000. Then we recognize cash payment or credit payment, which is payable or cash, 10,000. Then at the year end, we will recognize cost of sale, the amount sold, that's the worth of goods that was sold, 7,300. Then we are crediting inventory. Crediting inventory by 7,300 means we are deducting from inventory 7,300. So if we deduct 7,300 from initial recognition, which was 10,000, we'll have a net balance of 2,700. So that's for that. So this is as at the year end, 30th August 2020. So I believe this is understood. So what if we sold these assets for, or we sold some of these goods worth 7,300, we sold them for 8,000. So, we'll have to recognize sales, which is revenue. We'll credit revenue and debit cash, or we'll debit receivables, as the case may be. Debiting cash means we are receiving cash. Debiting receivables means we sold to them on credit. So, receivables are amount of goods sold to customers on credit. So, that's the amount we're expecting from our customers. So, that's for that. Periodic method and the perpetual method. So basically, periodic method is used for small companies, and perpetual method can be used for large companies where control can be taken care of well. So perpetual method will recognize inventory at every point of purchase, meaning that every time we purchase goods for resale, we'll recognize inventory at each point of purchase, which is constant updating. Then at the end of the period, we'll remove those value which we have actually sold from the total inventory. So that's why we're crediting inventory at the year end by 7,300. So if we credit inventory 7,300, we're deducting 7,300 from 10,000, which will give us a balance of 2,700. So that's an illustration for both periodic method and perpetual method. So I believe we understand the definition and the method of recording inventories now. So the next thing is the stock taking. Stock taking is just the process of, or the systematic count of inventory or of your stocks. Inventory was previously called stock before revised by IAS 2, which is now inventory. So we usually call them stock before. So stock taking involves just a systematic count of your inventories at each particular period. So at a particular period, mostly as at the year end. In most cases, it's always at the year end, but it is just a systematic count or a specific count of items left in store at the year end or at a particular point. So that's for stock taking. So another thing we have here is the measurement, inventory measurement. So inventories, according to IAS 2, is measured at the lower of cost. Inventories are measured at the lower of cost and net realizable value. So we measure inventory at the lower of either cost and net realizable value. So whichever is lower is what we will recognize inventory as. So if cost is lower than net realizable value, we will recognize inventory as cost. If net realizable value is lower than cost, we will recognize inventory as our net realizable value. So cost itself now includes some terms which involves, let me just break it down here. Cost component now, we have the purchase price, and we also have the conversion cost. So cost components for inventory includes the purchase price and the conversion cost. Purchase price includes the amount which was used to actually purchase these items. So just like the name, So it includes this, the invoice price for these goods, that's purchase price, purchase price plus every import duty and all non-refundable taxes which will be added to it. Purchase price includes the cost of purchasing this inventory, the import duties, all non-refundable taxes, carriage costs, and every other costs that may be incurred in relation to bringing this asset to its primary place of use. So that's for purchase price. Then conversion cost. So for conversion costs, these are costs incurred from bringing a raw material to finished goods. So cost of converting raw materials to finished goods before we can sell them are called conversion costs. So they include variable costs, labor costs, and every other cost that may be incurred to bring this asset to complete sellable condition. So cost incurred to bring raw materials to sellable conditions are called conversion cost, which includes the variable cost, the labor cost, and every other cost. Overhead cost also. Overhead cost. So that's for that. These are the measurements. So this is for cost. Then for net realizable value. Net realizable value. Net realizable value is the net amount that may be received or that may be obtained from selling an inventory. It's just as simple as that. Net realizable value is the net amount that may be received from selling an inventory. So net realizable value is termed as the selling price less estimated cost to sell. So this is net realizable value. So we said net realizable value is the net amount that may be received from selling an inventory. So it is the selling price less the estimated cost to sell an asset. For example, if I want to sell one of my goods for 10 million and I have to paint it or I have to advertise for 3 million before I can sell it. That 3 million cost of advertisement must be deducted from the selling price, which is 10 million. So my net realizable value will be 7 million in that case. Once again, I take it that if I am to sell an inventory worth of 10 million, and then I have an advert to make on that inventory, which is 3 million, then I have to deduct that 3 million to reflect my net realizable value. So that's for net realizable value under measurement of inventory. So whichever is lower between these two is what we recognize inventory as. So inventory is the lower, is measured at the lower of cost and net realizable value. So that's for measurement. Then we also move straight to the valuation techniques. We have the FIFO, which is first in, first out. And then we have the weighted average cost. So we can value our inventory using either of these two techniques. So we can either use the first in first out technique or use the weighted average cost technique. So under the first in first out techniques, inventories are measured or they are issued out according to their order of purchases or their orders of production. So we sell them or we issue out inventories according to their order of purchases or production. While under the weighted average cost method, we issue out inventory using the average cost of total inventory, dividing it by the average units of inventory. So using weighted average cost method, we issue out inventories at this cost. That's the average cost of total inventory to the point of issue divided by the average inventories of average units of inventories as at that point. So it means that this average cost of total inventory will include cost of initial or opening inventory plus cost of purchased inventory divided by units of the opening inventories plus the units of the purchased inventory. So the division of this gives us the weighted average cost which our inventory will be issued out with. For example, we purchase something in batches. Let's say we purchase 4 batches. How do we issue them? If we want to issue out 3 batches, how should we issue them? So using the first in first out method, we issue them according to how they came in. That's first in first out. The one we purchase first is the one that will be issued out first, which will be sold out first. Then using the weighted average cost method, we combine all of the cost of the total inventory as at that particular point of issue divided by the total units of inventory as at that particular period. So we'll take an example to illustrate this so that we can see how the first in first out method is being calculated and also the weighted average cost method is being calculated. So using the scenario, we have opening inventory as at April 1st was 250 at 75 naira each. Purchases during April, 750 units at 90 naira each. Then total units available for the month of April was 1000 units. Then units issued and sold was 500 units. So how are we going to calculate inventory at the end of the period using first in first out method and the weighted average cost method? So if first in first out method is used, it said the opening inventory of 250 units at 75 naira each. So that will give us 250 multiplied by 75. We have 18,750. This is the opening value of inventory. So we purchased additional inventory of 750 units. at 90 naira. So that will be 90 multiplied by 750, which is 67,500, making a total of plus 18,750. We have 86,250. This is the balance before issue. That's the balance. So we issued 500 units. So using first in, first out, we will issue 250 out of this 500 units at this price. We have inventory of 250 units at 75 naira each. So since we are issuing 500 units, we cannot issue 500 units from 250 units. Said according to first in, first out, we issue according to the order of purchase or the order of inventory in our books. So we have 500 units, 250 is still existing. So we issue at first 250 units at 75 naira. So it means that everything here have been sold out with this. But what we are issuing is 500 units, not 250 units. So the remaining 250 units will be taken from this. So which is 250 at 90 naira now. 90 naira. This one will give us the value of our inventories issued times 75. And this gives us 18,750 and 250. This gives us 22,500, making a total of 41,250. So this is the total value of the inventories that were issued. So the closing balance now at the end of April will be 86,250 minus 41,250, which is 45,000. So this will be the value of inventory at the end of the period using the first in, first out method. So if the weighted average cost method is used, said we issued out or we have opening balance, opening inventory of 250 at 75 naira, which gave us a total of 18,750. Then we purchased additional 750 units at a cost of 90 naira per unit, which gave us 67,500. This before issue gives us 86,250. So using weighted average cost method, we said we'll issue out. So there is an issue of 500 units. So the cost at which we will issue this 500 units is what we are trying to calculate. So we are using weighted average cost method now. We have the formula is the cost of initial opening inventory, which is this, the total cost of the initial opening inventory plus the cost of purchased inventory till the point of issue, which is this 67,500. So the addition of the two gives us 86,250 divided by the unit of opening inventories plus the unit of purchase inventory. Unit of opening inventory is 250, while the unit of purchase inventory is 750. The total units we have is 1,000 units. So in other words, our weighted average cost method will be 86,250 divided by 1,000. This is naira. This is units, 1,000 units, which will give us 86.25 naira, which is 86,250 divided by 1,000. 86.25 naira. So we'll issue out these 500 units at 86.25 kobo, 86 naira 25 kobo. So we have at 86.25, which will give us times 500 now. 43,125. So this is the total issue using the weighted average cost of capital. So inventory at close now. So inventory at close will be 86,250 minus answer, which will give us 43,125. So this will be the inventory at close using the weighted average cost method. While using the first in, first out method, we got a different answer using that. So this is just to illustrate the calculation of first in, first out and the weighted average cost method. So we can now proceed to, so another important thing is the inventories written down. So inventories written down is just as a means of inventories reducing in value. So the process whereby the cost of inventory is higher than its net realizable value. So we said inventories are measured at the lower of cost and net realizable value. So inventories are measured at lower of cost and net realizable value. We said cost includes the purchase price, the import duties, all non-refundable taxes, and every other cost incurred to bring these inventories to their sellable conditions. And net realizable value is the net amount that can be received from the sales of an inventory. So in most cases, the net realizable value of an inventory is always higher than the cost of an inventory. So in most cases, the net realizable value should be higher than the cost of an inventory. But in a case whereby the net realizable value is lower than the cost of an inventory, it means that the inventory has suffered some damages, which is as a result of obsolescence, then deterioration, and also damages. So just like we said, inventories will now have to be written down. So if the net realizable value of an inventory is lower than the cost of an inventory, the cost of an inventory should be written down to reflect its net realizable value. That's just the meaning. So for example, if we have the cost of an inventory to be $80,000, then we say the net realizable value. Let's assume we have the selling price to be 120,000. Then we have cost to sell. We have 50,000. So NRV now. Net realizable value becomes 70,000. So in this case, it means that our inventory, which we produced or purchased at 80,000, had suffered some loss or some damages, which will make the net realizable value to be lower than the cost. So ordinarily, the cost of an inventory should be lower than the net realizable value. But in case where we have NRV to be lower than cost, then it means that we have to write down our initial cost of inventory to reflect the net realizable value, which results back into the measurement of inventory, saying that inventory is to be measured at lower of cost and net realizable value. So if we had initially measured inventory at 80,000, then we have to write it down to reflect this 70,000. So it means, how do we bring down 80,000 to reflect 70,000? So the deduction, which is as a result of damages, this reduction might be as a result of damages, may be as a result of changes in prices, may be as a result of obsolescence and every other thing, deterioration and the likes. So So, but let's assume it's as a result of damages. It should be written down and added to the cost of sale. So we will write it down to cost of sale. So it has depreciated or it has reduced in value by 10,000. That 10,000 should be added as part of cost of sale. So we will debit cost of sale by 10,000. So we're adding 10,000 to cost of sale. Cost of sale is an expense. If you are debiting expense, it means we are adding to the expense. Don't forget, they will credit inventory itself. Remember, inventory is a current asset in the statement of financial position. Current asset. We will credit it by 10,000. We said the inventory was initially recorded at 80,000. Let's say last year it was recorded as 80,000. Now we found out that our net realizable value is 70,000. We have to bring down the cost of 80,000 to reflect the net realizable value, which means that inventory is to be measured at the lower of the two. So it has to be recorded at this, should be measured at this. So we have to deduct 10,000 from this to reflect this value. So we will debit cost of sale with 10,000, mean that we're adding this 10,000 as an expense. Can term it as damages. So cost of sale is an heading. So we'll add 10,000 to it as a damage from inventory. Then we'll deduct 10,000 from inventory itself also as a damage. So we're deducting 10,000 from inventory and we're adding 10,000 to cost of sale. So at the initial or at the reporting date now, our inventory will be reflecting 70,000. So that's in the case of inventories written down. So we may have several reasons why the cost of inventory will be higher than the net realizable value. So it may be as a result of damages, obsolescence, changes in price, interest rates, and so many other factors. So that's for that. Then lastly, we have the disclosure requirement. So disclosure requirement. One of the things which an entity must disclose in accordance to IAS 2 is your method of valuating inventory. That's one. You must state in your notes to the account the method by which you are using to value your inventory. Also, you must state the method of recording your inventory. So this method of evaluating inventory, which we said is divided into FIFO or weighted average cost. Then you must also disclose the method which you are using to record your inventory. Method of recording inventory. So this might be either the periodic method or the perpetual method, like we have said. So that's for method of recording inventory. Then you also must state the carrying amount. The carrying amount of your inventory at every reporting period. So an entity must state the carrying amount of its inventory at every reporting period. Remember that for a manufacturing company, inventory is divided into raw materials, raw materials, work in progress, and then finished goods. So you must state the carrying amount, which is the current worth of your inventory at the end of each reporting period. And it must follow the measurement according to IS2, meaning that it must be measured at the lower of either cost or your net realizable value. So that's for that. Then you must also state your net realizable value. You must disclose your net realizable value at the reporting period. You must also state if there is any damages or inventory written down? If your inventory is written down, you must state if your inventory is written down. So an entity must state if its inventory is written down. And lastly, you must disclose the reason relating to the written down of your inventory. So this, we said, it might be as a result of damages, might be as a result of inflation, market changes, competitors, and several things may actually result into your cost of inventory to be lower or to be higher than your net realizable value. So this is all relating to the explanation on IAS2 inventory. So we'll take a comprehensive question from the Professional Corporate Reporting May 2017 question 4. Question 4C actually, the 4C is the one relating to IAS2. The whole question 4 is a combined question of many standards. So some of which we have done, IAS 38 is part of it. But the question 4C is what relates to IAS2 particularly. So question 4 is Dango PLC buys raw materials from overseas suppliers. It has recently taken delivery of 1,000 units of component X used in the production of chemicals. The quoted price of component X was 1,200 per unit, but Dango PLC has negotiated a trade discount of 5% due to the size of the order. The supplier offers an early settlement discount of 2% for payment within 30 days, and Dango PLC intends to achieve this. Import duty of 60 naira per unit must be paid before the goods are released through customs. Once the goods are released, Dango PLC must pay a delivery cost of 5,000 to have the components taken to its warehouse. Require write a report to the directors advising them on the correct accounting treatment of the above transaction in the financial statement for the year ended 30th September 2016 in accordance with the provision of relevant standards. So just like I said, this particular question, the number 4C is the one relating to IAS2 inventory. Now, 4C, question 4C, okay. Tango PLC. It says that it purchased raw materials from, so we have material. Remember that we said inventory includes raw materials, work in progress, and finished goods. Don't forget. Has recently taken delivery of 1,000 units of component X. So the material is component X. Component X. So it purchased 1,000 units. Production of chemicals. The quoted price of component X was 1,200 per unit. So at 1,200 per unit. So 1,000 times 1,200, which is 1,000 times 1,000. So we have 1,000,000. Let me put the price here. 1,200,000. So that's that. It says that the Tango PLC has negotiated a trade discount. Remember that trade discount must always be removed. Trade discount. When we did IAS 16, we also did something like this. Trade discounts of 5% due to the size of the order. So 5% of 1,000 of 1,200,000 will give us 60,000. So we're deducting this. So we have 1,200 minus 60,000. So we have 1,140,000, which is the net amount. So continuing with the question, It says that the supplier offers an early settlement discount of 2% for payment within 30 days, and Dango PLC intends to achieve this. This offer of 2% is a cash discount. Cash discount is not an expense, neither is it an asset. So it should not even come as part of the cost of the asset. It is an income which should be recognized in the statement of the profit or loss of Dango PLC. So the cash discount of 2% is not to be recognized as part of the cost component of material X. So that's that. So import duties. Remember I said purchase price includes the actual amount you used in buying this asset together with all import duties, together with all non-refundable taxes. So import duties. Import duties of 60 naira per unit. So we have 60 naira multiplied by the total unit purchase was 1,000 units, 1,000. So that will give us 60,000. Remember that we're capitalizing this, we're adding it as part of the cost. We're adding it as part of the cost, we're not deducting it. Then also says once the goods are released, Dango PLC must pay a delivery cost. Delivery cost just like transportation cost, carriage cost, just like we explained. Delivery cost now. Delivery cost of 5,000 is also should be added as part of the cost of this asset. So to have the components taken to its warehouse. So said all other costs in bringing this inventory to its sellable condition should be capitalized as part of the cost of the asset. Remember that if there is any other cost that will bring this asset from its original state to its sellable condition, for example, if it is refurbishing, we have to add that cost as part of the cost of the inventory. So this 1,140,000 plus 60,000 plus 5,000 will give us 1,205,000. So this becomes the cost of the inventory according to IAS 2. So this is the cost of the inventory according to IAS 2. So in relation to this question, that is all that was required. So the question is to calculate the cost components. The most important part is the 2% cash discount that was included as part of the information. The 2% cash discount is not to be added as part of the cost of the asset, but rather should be taken as other income. Cash discount is an income to the entity. So it should be added as an income, other income, in the statement of profit or loss. So we have been able to look at IAS 2, which is inventory. And I believe we understand how inventory is calculated. We've looked at the definition by saying that inventories are assets held for sale in the ordinary course of the business, which we define according to a retailer and also by a manufacturer. To a retailer, inventory are those items stocked for resale, while to a manufacturer, inventory includes the raw materials, work in progress, and finished goods. Then we have the methods of recording inventories, which is periodic and perpetual. Periodic only records inventory at the end of the period, that's at the end of the accounting period, while perpetual uses constant updating of inventory. At every time we purchase inventory, we must at every time we purchase goods, we must record inventory. That's for perpetual method of recording inventory. Then stock taking, we said it is just the physical verification of items in our books or in our store, just to check that this is the amount of stock we have left as at this particular period. That's stock taking. The measurement of inventory according to IAS2 is to be measured at lower of cost and the net realizable value. Now we said cost has some components which includes the purchase price, the import duties, less trade discounts, and all non-refundable taxes should be added to it. Then we should also capitalize all additional costs that will bring this asset to its sellable condition. So that's for that. The net realizable value is the net amount that will be received or that will be obtained from selling an inventory, which includes the selling price less the estimated selling expenses. That's for net realizable value. Then the inventory valuation technique, which is divided into cost in first out, which is FIFO, and then weighted average cost of capital, weighted average cost method. Sorry. So that's for valuation technique. We also took an example to illustrate that. so that you can understand better. Then disclosure requirement says, we said entity must disclose some important parts of financial statements in accordance with IAS 2, must disclose the methods of recording your inventory, must disclose the evaluating techniques of inventory, must disclose your current amount of all of your inventory at a particular period. You must also disclose the net realizable value of your inventory at the reporting date. You must disclose if there is any written down inventory, and you must disclose any reason for that inventory written down. So according to this, we also took an illustration to show better understanding from the ICAN professional level, May 2024, May 2017, question 4. So I believe we understand all on inventory IAS 2. But in case there's any other question, please use the comment section below and I will read and get back to you. Thank you very much for staying with us so far. We'll see you in the next video. Once again, my name is Caleb and this is Study with Caleb. Please like and share to as many as possible people that may actually need this, and then subscribe also. Thank you very much.